Hello, I've returned with another ADH Wealth solution. Today, we will begin to discuss fulfilling all of your financial needs. As always, this is a basic description. For an evaluation of your own, please schedule an appointment. My information is in the description. Lastly, make sure you hit the like, drop a comment, and if you're new, subscribe and hit the notification bell so you're made aware every time I release new content.
I'm gonna send it to you right now. I'm gonna send you a live right now. I don't know if they're gonna let you in, but I just sent you one. Marie Brin 1. I think that's right. I don't know if they're gonna let you. They be tripping. Like, I think I'm giving away too much game. Just thought of the traffic course. Love it. Too soon for the master class. Nah. So I sent out some lives. I don't know if they let me do it. Yeah. I went live with too many people. No, not for the master class. Trap masters, y'all don't have to worry about it. Chill. Alright, what's good, Quinn?
Hi, good morning.
Good
I
morning.
just want to know what's the best sector to be in for long-term hold accounts.
The best sector to be in. So I would say right now, healthcare, fintech, cybersecurity. Find one of those industries. Healthcare is good. It's always growing. America is building on healthcare, right? Tech sector is growing. I like tech because I like healthcare because it's also blending tech inside of it. So healthcare, technology, and the fintech industry are great places to be right now.
Okay. All right, so thank you. Appreciate it.
Righteous, queen. Alright, y'all, so that's it. I'm about to tap off. Listen to me, man. Appreciate y'all this morning. I did dope. I like y'all. I love y'all. I'm gonna start doing this. Be well. Trapping Tuesdays is coming back here for the show. Everybody, man, we had 700 some people here right now. I'm telling y'all, man, come join Trap Anonymous. $47.99 a month, or you get 6 weeks, 7 weeks free. You get it for the year, man. It's your boy, the Washington Trap, man. Love y'all. I'm out.
Hello. It's your boy, the insurance junkie, your fiduciary fella, the all-star advisor, Alonzo Hall. And I've returned with another ADH Wealth solution. Today, we'll be reading an article from Think Advisor from Morningstar.com research, and a report that shows why investors need professional advice. A September 3rd, 2021 article by Bernice Napak. So, before we get started, ladies and gentlemen, if you like my content, make sure you hit that like, drop a comment, subscribe, and hit that notification bell so you're made aware every time I release new content. And as always, share. Lastly, if you'd like to contribute to channel growth, my information is in the description. So before we go into this article, let's talk about the fact that this article by Think Advisor says, Morningstar Finance says, there's a report that shows why investors need professional advice. You don't need to go to people like Wall Street Trapper and pay him $3,500 to tell you, quote unquote, what to invest in. You don't need to go see people like my man from Instagram, Marcus Aurelius, aka Keeping It 100, and pay him $10 to join his Facebook group so he can tell you what to invest in. Why? Because they're not professionals. Now, if you want to go see these people for whatever they do professionally, like Keep It 100, he does photography. You want to go see him for a picture? It's much more better that you go see him for your photography than me, because he's a professional at photography. So he's going to take those proper pictures for you, because what he eats don't make you shit. Therefore, what he invests in is not what's the best thing for you to invest in. Even if you've made a few dollars because his investment made a few dollars, that's coincident. A broken clock is right 2 times a day as well. But there's a reason that people go into that profession. And there's a reason that we hold these licenses. It's not just to say we hold these licenses. There's reasons for it. So let's see. Morningstar's latest annual Mind the Gap report, comparing investors' returns from mutual funds and ETFs with the returns that funds report, supports the view that investors could use the help of professional financial advisors. So, all y'all folks, I like to do it myself. I'm self-taught. No, spend the money so that you make more money. There's a meme in real estate where it goes, a person says, I saved $12,000 or I saved $9,000 by not paying commission to the realtor. But then the meme also says you lost $20,000 in asking price by not using a realtor. So if you saved $9,000 and lost $20,000, so technically you lost only $11,000 because you saved $9,000 by not paying commission, but that $9,000 that you didn't pay lost you an additional $11,000. You see why it makes sense to use the professional? Because see, it's real estate. That's something tangible that you can look at and touch and feel, so it should make sense to you. But it says, Morningstar's latest annual report, Mind the Gap report, comparing investors' returns from the mutual funds and ETFs with the returns that the funds report, supports the view that investors could use the help of professional financial advisors. Bad decisions such as trading too often, buying funds after they've already run up, and selling in a panic after market declines can all chip away at investor returns, according to the report. The report found that investors earned an average of 7.7% per year on their mutual fund and ETF investments over the 10 years ended December 31st, 2020, compared with a 9.4% average total return generated by the funds themselves. So that shows that had they had a financial advisor, they probably wouldn't have been at that 9.4% return, but somewhere in the middle, probably at 8.7, a whole percentage point or basis point. When if you're looking at $100,000, 1 point is $1,000. It's a big difference. The 1.7% percentage point gap means investors gave up about 1/6 of the return they would have earned if they had just bought, then sold the fund shares. The report used an asset-weighted methodology to calculate these averages. The biggest and smallest gaps. Morningstar found that the biggest gaps in returns involved alternative and sector equity funds, which generated about 4 percentage points more on average than what the investors had collected. Sector funds are particularly prone to performance chasing, with investors often piling into popular sectors after a strong showing and then bailing out when they fall out of favor, according to Morningstar. Alternative funds, which have relatively low returns of just 4% annually, were the most volatile and subject to greater trading activity. Investors in alternative sector equity and international equity funds would have done significantly better by dollar cost averaging, Morningstar wrote. But dollar cost averaging has its drawbacks too. If returns are generally positive, investors are typically better off making a lump sum investment and holding it for the entire period, according to Morningstar. Investors who buy and hold can take full advantage of performance trends when total returns are positive, but investors who contribute smaller amounts over time often have fewer dollars invested during periods with strong returns. The gap between the investor and fund returns was smallest for allocation funds with 50 to 70% invested in stocks, 0.47%, and for intermediate core bonds, 0.38%. Investors in core bond funds aren't as prone to poorly timed asset flows as other areas because they tend to stick with core holdings, according to Morningstar. The same can be said for asset allocation funds, a favorite among buy and hold investors, according to Morningstar. Some tips for investors from Morningstar. Morningstar concludes its reports with these tips for investors. Focus on holding a small number of plain, vanilla, broadly diversified funds. More broadly defined offerings such as U.S. equity and taxable bond funds have fared significantly better than narrower offerings such as sector funds and alternatives. Automate mundane tasks such as asset allocation targets and periodic rebalancing. Set a rational asset allocation, buy low-cost funds, and stick with the plan, setting a strict schedule for rebalancing such as yearly or when allocations drift significantly from target levels. Avoid narrow or highly volatile funds, with a few exceptions. Funds that expose investors to less volatility and are easier to own are less prone to erratic cash flows. Embrace techniques that put investment decisions on autopilot. This does include dollar cost averaging, but investors who are able to buy and hold because they have the means and the temperament will likely enjoy the best results. Still, systematic investing helps avoid the pitfalls of poorly timed inflows and outflows, according to Morningstar. Ladies and gentlemen, if you enjoyed my content, make sure to hit that like, drop a comment, subscribe, and hit that notification bell so you're made aware every time I release new content. And as always, share. Lastly, if you'd like to contribute to channel growth, my information is in the description. Finally, wipe ass, work in progress every day and see success. Wipe ass, work in progress every day and see success. Wipe ass, work in progress every day and see success. And remember, when people challenge you, they don't challenge you to challenge you, but they challenge you to challenge. Accept the challenge. Salute. Interested in having an evaluation? Find my contact info in the description and schedule a consult to explore your options. Have a financial question but don't know who to ask? Email me at a.paul@cgwealth.financial and your question may be answered in my next video. Security products are subject to investment risks, including possible loss of principal. Before investing, carefully consider the investment objectives, risks, limitations, charges, and expenses of the product and any underlying investment options. This information can be found in the product and investment option prospectuses. Copies are available from your registered representative.